Helena, who's been mentioned many times, who's spoken already, who's been praised very much by Catherine and by us. And Helena Viñes Fiestas will kind of take us to the last panel, which really is the culmination of the whole report, which is kind of the regulatory and public policy response. And given we're in Brussels, where regulation and policy is kind of the output that we know best, this will be an interesting panel. So I pass over to you, Helena, to take us through this discussion.
Thank you, Nick, and good morning, good afternoon, good evening to all of you from wherever in the globe you are joining us. Catherine and the rest of my colleagues from the UNHLAC have been explaining what criteria pledges and transition plans should meet in order to be credible. More importantly, what is needed so that the pledges turn into real action, which is what this is all about. It is about turning pledges into real action. But besides that urgent need to enhance the quality of the pledges, the transition plans, and the reporting in line with the recommendations that we've made and that you've been hearing today, which they are very much seriously needed, we face an even bigger challenge, which is that we need to persuade to all of those of non-state actors who have not yet committed to net zero, which are the vast majority. You have heard it before, only 1/3 of the world's largest publicly traded large companies have committed to net zero, and that leaves 2/3 out, plus the vast majority of the privately owned and state-owned. If we were in an in-person meeting, I would ask all of you, I would ask you to raise your hands how many of you think that we can achieve both the enhancement of the quality of the pledges and transition plans, and at the same time persuading all the rest of non-state actors to commit to net zero, and for the commitments to be of high quality in the short time framework that we got. And I'm sure the vast majority of you would agree that it's just not going to happen, not in a voluntary basis and not in the time framework that we got. Let's be honest here, and let's be very, very realistic. There's only one way forward, which that is regulation. And this is the reason why the UNHLAC, we believe that the time has come for countries to begin regulating net zero, to turn the pledges into action, but also to ensure consistency and competitiveness. More concretely, we believe that regulators should start, first with a high impact corporate emitters, including privately owned and state-owned enterprises and financial institutions, and then mainstream net zero reporting. But it's not only about transparency. We are in such an urgency that transparency is not enough. We need to go farther, and we need to set standards for the transition plans and the net zero pledges in line with our recommendations, which includes third-party independent verification, and which is the topic that it was just discussed in the previous sessions. One thing I would also like to highlight is that despite the science having warning us for the last decades on the urgency to fight climate change, the reality is that the policy related to climate change, and in particular around financial regulation in this area, is actually relatively new, not to say very new. And this is a new world also for regulators and supervisors across the world. And we sometimes forget how much training and how much training, education, information is also needed in this area, also within, in the community of policymakers. Another area that we also forget many, many times is that net zero touches upon many different regulatory domains, many different policies, and that exercise of being really consistent and review sometimes the regulatory frameworks in order for them to be aligned is also very much needed. And this is why we believe that more than ever there is a need to connect policymakers and regulators, both from across borders, but also from across regulatory domains. And in that respect, the UNH-LEG, you might have heard it before, you might have read it in our report. One of our proposals moving forward is the launch of a new task force on net zero regulation that convenes a community of international regulators covering all industries to complement the voluntary action with clear rules to work together towards net zero. Now, in the next hour, this is exactly what we're going to discuss. We're going to discuss the extent to which that space for policy discussion and mainstreaming net zero regulation is needed and how it could work. The discussion will be framed following the 3 areas that we have identified that probably this new task force on net zero regulation should cover. The first one, net zero reporting and the establishment of a set of mandatory standards. The second one, gaining greater consistency across regulatory domains. And the third one on training and support. For that, we have 4 extremely notable speakers. Kris, Nathanail, Senior Policy Advisor from IOSCO, representing the International Network of Financial Market Regulators and Supervisors. Good morning, good afternoon, Kris. Martin Spolc. Hello. Martin Spolc, Head of Sustainable Finance at DG FISMA here in the European Commission. He needs no introduction for the vast majority of the audience. Good afternoon, Martin.
Hi, Helena. Good afternoon.
And representing the private sector voice, bringing the private sector voice, we have Viktoriya, Head of Group Sustainability from Deutsche Bank. Good afternoon, Viktoriya.
Good afternoon, Helena and everyone.
And Tomohiro Ishikawa, Head of Government and Regulatory Affairs at Mitsubishi Financial Group, or MUFG. Good evening, and I believe it's really, really late there in Japan. So thank you so much for making the effort to join us at these late hours. It was a pleasure to meet you, Tomo, at COP27. Kris, Martin, Viktoriya, and Toma, thank you for joining us today. It's been much, much appreciated. But let's start with the net zero reporting. And I'm going to start with our financial institutions representatives, because I believe financial institutions are really interesting, right? Because they're a two-edged sword. On one hand, you're users, you are demanders of this information from the companies you finance. And on the other hand, you're also preparers, you're also asked to respond. So it's a really interesting perspective that you bring to our discussion. Viktoriya, what is the benefit of having only 1/3 of the publicly traded, of the largest companies in the world, publicly traded, committing to net zero, and how important it is for a bank such as yours that the non-financial companies that you invest in actually develop a transition plan, and that those transition plans are detailed? What do you need it for? Thank you.
Yeah, thank you, Helena. And a good question. You know, how important, or what is the benefit having only 1/3 of companies having already net zero plans? I think, first of all, it's very encouraging to see that already 1/3 of companies have such net zero commitments. But of course, and I hope, you know, if you think that this type of commitments have been all made only in the last couple of years, which is again very encouraging how quickly and swift we can mobilize the industry to move, be it financial industry or the real industry. And I think it's a very encouraging dynamic, and of course we hope that it will continue. But of course, as I think you've been discussing through the whole conference today, it's very important to have credible plans, sufficient data, comparable data, and because in the absence of existing aligned shared definition, there are also multiple risks that we face. You know, one of those risks is the risk of green or transition washing if we cannot rely upon this, because our commitments as financial industry are highly dependent on the quality of the transitional plans of our clients, so to say. Also, another challenge that we might face is the risk of, if the plans are not clear, are not sufficiently detailed, we might face the risk of underestimating the transitional risk for us, and again, not being able to take real actions we need to deliver on our own commitments. And I think against this backdrop, again, coming back to the question why it is positive to have only 1/3 of companies having such plans, I think the positive is also next to a huge kind of development in this space is also the idea that those who are not there yet, the 2/3 that need to move, can definitely benefit from previous experience of the first movers, can learn, can definitely adopt the best practices which are very quickly emerging and developing. I think it's also important because, you know, it's like everyone, those companies which will be now moving will benefit from the experience of first movers, but also will be better maybe placed to benefit from already knowledge, networks, in international standards being available. Because I think, like you were discussing before, and also in the previous sessions that I had a pleasure to listen into it, we all need to invest in capacity building, in training. It will require investments, time. Therefore, I think this idea is that to move the 2/3, which maybe not the first movers, will definitely have an advantage to benefit from what we have already in place. And so I think, and this is very, very positive. And I'm just looking at us, I think as a financial industry, and I guess Tomo will reconfirm, we have a role to play, and we just issued our own net zero plans and commitments for 4 industries. They're totally dependent on our clients. Therefore, one of the key priorities we have today is engage in transition dialogues with our clients. And when we will be engaging with those dialogues, we of course will will be able kind of to utilize already this thinking in the markets that we have, just to also help the clients to develop credible transition plans. I can't hear you, Helena.
Sorry, I thought you had finished, Viktoriya.
No, I was just saying, I think this is in terms of benefit, so from a benefit perspective, you know, and in terms of, because in another question you were mentioning, why do we need it and why it is important we need those credible plans? I think I touched upon this, but maybe to stress, I think the risk of greenwashing, the risk of transition washing is very high, and without a joint concept, it might hinder financial flows, which we can allocate towards transition. And this is something to keep in mind. Therefore, also from a regulatory perspective, it will be important to create an environment that will encourage transition finance to happen. So to say, I think this is a risk. And another one, as I was just mentioning, we are very much dependent on how or how detailed the transition plans of our clients are. Therefore, the engagement with the clients on transition is key, but the engagement also based on some credible parameters, because already today we use more than 10 indicators to assess how credible the plans of our clients are. And of course, us as financial industry and our clients, we will all benefit from a more coherent approach and coherent framework of what constitutes a well-articulated, credible transition plan.
Thank you, Viktoriya. Thank you, because you have set the scene perfectly. And I'm going to turn to you, Tomo, because Viktoriya mentioned, you know, how important it is for financial institutions and actually to ensure that the plans are credible and there's no greenwashing, or shall we say transition washing in it. And that's exactly what the recommendations of the UNHLEC tries to address, which is that it is in a way a benchmark that can help everyone, and not least financial institutions, to ensure, you know, to assess those transition plans and to ensure that they are credible. Tomo, I would like you to take the double perspective. So on one hand, thinking that our recommendations as the benchmark against which to assess companies, and at the same time thinking of the benchmark as your, you know, sorry to repeat, as the benchmark for setting your own transition plan and your net zero. Tomo, give us your thoughts on that.
Sure. Thank you very much. And thank you very much for inviting. It's almost midnight, so let's hope my brain is working. But I think the question, and also Viktoriya already said this, but at the end of the day, for any financial institution, especially for banks like ourselves, or I'm sure it's same for other commercial banks, at the end of the day, our client's transition plan collectively is our transition plan, right? There's no way we can for banks like us who committed to net zero, we cannot achieve net zero without our client aligning to net zero. Or in another way, we can only achieve net zero through our clients achieving net zero, and that's where dependencies. But I would frame it as an opportunity for us. But let me step back a little bit and briefly discuss why transition plan and transition finance is important. We, MUFG, committed to net zero by 2050 and became a Net Zero Banking Alliance member. This was like 18 months ago. And since then, we've been stressing that transition finance is the key enabler to achieve a low carbon economy, not just in Japan, not just in Asia, but basically globally. And the precondition of banks achieving net zero, as I said, is that the client or the real economy achieving net zero, given the size of our balance sheet. And I had the privilege of chairing the Net Zero Banking Alliance Working Group, which just published the Transition Finance Guide. And the key message we wanted to say in the guide was that it's a high-emitting sector that requires funding, and they also need time. So, of course, transition is what we all want to achieve, but the transition will take some time. It's not going to take place overnight. Some sector needs some time, but how fast can we how can we accelerate their transition is the question we need to be asking, and that's the whole purpose of client engagement. Having said that, of course, we also need to think about energy security, for example, and also the communities and individual impacted, et cetera, et cetera. So we also need to think about this energy security, the just transition. All of that has to be part of the equation. But going back to the this transition plan, what the value of transition plan for us is the following. So since this TCFD framework was established 4 or 5 years ago, we've been discussing about risk and opportunities, right? But transition plan by the corporate or the non-financial companies will allow us to identify the financing opportunities, right? So I think that's where this opportunity comes in, and how can we finance our clients' net zero journey is in the transition plan. So that's where we can provide value by saying, here's how we can facilitate your transition, and here's how we can finance your transition. And as Viktoriya said, having said that, this credibility of transitions plan is critical, right? At the end of the day, unless the plans are credible, there's no way we can finance, nor that we'll be able to, we together with our client will be able to achieve net zero. So that's why transition plan has to be published, but also credible. Credibility has to be also secured. So in that sense, we welcome the idea that, for example, ISSB, IFRAG, ISEC all included transition finance as one pillar of the disclosure, because it has to be publicly available and also has to be credible. I just want to also point out 2 open questions in the context of a transition plan. First of all, the transition plan cannot be just a catalog of technologies and innovations. Sometimes you see some companies saying, here's our net zero plan, and these are the technology that will reduce the emission. I don't think that's good enough. The transition plan has to include how they will be financed, not just for the purpose of us identifying the financing opportunity, but I think that's where the credibility comes in. So it's not just about technology, but how do you finance those? And Helena, you always talk about CapEx. That's where CapEx kicks in, right? So I think the transition plan has to be technology combined with financing plan. Second, it's a bit of a challenging discussion we need to have, which is how firms can express uncertainties with respect to transition plan. I understand you want to regulate, and I think it's good to some extent regulate or mandate transition plan. But given the transition plan will be several decades long, knowing that there'll be some 2030 midterm target, but still the transition plan will be 20, 30 years, right? And this is not just about KPI or numbers. This is actually transforming your company over the next 2-3 decades. So this is about strategy, not just numbers and KPIs, right? And of course, for any strategy, there are some uncertainty. There are some unknown factors that you may not be able to control. So the companies will have to express, these are the unknown factors or uncontrollable factors, but still we think, we hope to achieve 2050 net zero. So the company have to express that uncertainty. How do you do that is a one, I think, big challenge. for us, but also for the corporates. One idea I thought that makes sense was UK's approach in the context of this TPT consultation paper that they published. Was it last week or 2 weeks ago? They're talking about sensitivity. So maybe that's one way to think about this uncertainty. So the company can say, what happens if kind of scenario in the transition plan? Because, you know, if you think about 20, 30-year transition plan, it's not like one scenario that will happen no matter what, right? There will be some, twists and turns. So I think that's where we need to be mindful about transition plan, given it's not 2-3 year plan, but it's 20, 30 years. So going back to your question, Helena, so I think this transition plan will provide us with a great opportunity for us to identify transition financing opportunities. But again, transition plan cannot be just about KPI, not just about technology, but how do you finance? How do you basically implement the transition or strategy to achieve net zero? Has to be comprehensive. And that's where I think company has to think very carefully about how they want to articulate. It's not just about numbers and, you know, nice presentation, but again, you know, 1/3 have already committed, but 2/3, it's almost about capacity building. And I'm sure both Deutsche, MUFG, all of us can help our client to develop their capacities and come up with credible transition plans. Let me stop there. Thank you.
Thank you, Tomo. I wanted to touch upon one thing that you said is really important, which is the need to express uncertainties. Yes, and I think that under uncertainties we can we can include many things, and I want to separate two things. There's the uncertainties of whether or not the rest of the economy is going to meet net zero, but there's also all the uncertainties or the lack of today of knowledge of, for example, for certain sectors for which there's no technological technological solution to reach net zero or not economically viable. And I'm glad to hear that we agree on that the way forward, at the very least, is to be transparent about it, right? So what we need, and this goes very much into what we had the discussion on carbon credits, voluntary carbon credits. It's not about offsetting and continuing business as usual. You have to be honest about the amount that you can actually reduce your emissions, and then you can offset, but you need to be very clear and transparent about it. However, when it comes to, and it's really interesting about the scenarios, yes, because scenario analysis, it's really useful to assess for risk management and for assessing where we are and how the different companies or financial institutions are going to deal with potential scenarios, as it says. However, the report is very clear that what we're talking about here is that everyone should, when they commit to net zero, they should commit to the 1.5 with all the details that we have explained. Yeah. On that note, Viktoriya, do you think that we should make mandatory committing to, committing or to develop a transition plan that actually is in line with the 1.5 objective, by 2050, the latest, with no or limited overshoot? And on that line, I'm thinking of, you were mentioning the advantages of having, 1/3 already, like paving the way, yeah? But I said at the very beginning, the problem is that we have very little time, yeah? So should we regulate? Should we make it mandatory?
Yes, and I said a good question. I think so. First of all, and in a sense of having, as I was mentioning, having this aligned frame of criteria, what constitute, and number of recommendations that you have included in the report go exactly in this direction, to have a joint understanding what are the elements of the credible transition plan. And this understanding, from our perspective, definitely should be a global understanding, because any regulatory fragmentation means also cost, transactional cost, information cost. It makes it challenging for globally operating firms, for globally operating financial institutions like ours. So definitely, any form of harmonization of the asks and demands definitely should be considered, because you say, should we regulate? The question for us is always regulate where? You regulate in European Union, regulate it globally, so I think whatever we would be trying to regulate, definitely we should try to do it globally, because as I just mentioned, the fragmented landscape we're already facing from a regulatory perspective is already causing higher, compliance, due diligence requirements and information costs. I think the system in general. I think from my perspective, and it's a valid point, should we make it regulation? I think we should, from my perspective, we should try. There should be, the Paris Agreement says the trajectory needs to be 1.5. We need to do it. There is a science behind this, and I think we should be guided by the science. I think from my perspective, this is absolutely key. In terms of regulation, I think the only ask, and I know it's not an easy task to solve, but for example, our clients in different jurisdictions, in different countries, will also have maybe a different social and economic context. And I think whatever we try, so even if we're trying to achieve the 1.5 consistently across all sectors, all geographies, I think a certain adaptation and taking in account local context, one of the recommendations you were giving, just transition, for example, needs to be factored in, needs to be considered, because I think there is a need to have a right balance, a right balance between those who are 1/3 and much more progressed, and those who are 2/3 and maybe not that yet progressed and needs the time and investment and financing, like Thomas said, to speed up. And it ranges not only from capacity building, from understanding, from availability of technology, from scaling possibilities, from social context. Therefore, I think it's the right thing to think of a global harmonized criteria and regulation with 1.5 and the back, but certain balancing for local context will be important, because I think also thinking about the regulation, I think with the mindset we should apply it should be incentivization. It should be, not to punish, but to enable, to encourage. And therefore, like Tom also was saying, the regulatory framework we're trying, what should be delivering, first of all, a support for financial opportunities. It also should deliver for enabling those who are 2/3 to transition, to really embark on this journey credibly. I agree with you, but really should be enabling. And also, just to finish from my perspective, just to make point what Thomas was saying, those uncertainties, I think I would really very much echo this discussion around this, because we're not talking about 1 to 3 years plans. These are long-term perspectives. They will be very full of different uncertainties. Therefore, my point that I was making, whatever the regulatory landscape we create, it needs to be encouraging transition and transitional finance.
Thank you. I wanted to let you know, Viktoriya, that when we discuss it internally within the UNHLEG, it was clear to us that the 1.5 was the global target, and that was translated differently in different geographies, for all the reasons that you mentioned, And then when we talk about regulation, we said, and setting the criteria, which is quite, strict from an environmental perspective. We're saying, well, should we make any differences? And we agreed that when it comes to the world's largest companies, that they are global, and the global financial institutions, they're global. So therefore, they should stick to the global target. And for those, you could actually require the same, criteria, making it very, very clear that we're not talking about the small, medium enterprises in developing countries. We're not talking about smaller, even if they're large, but smaller, companies that only operate, in one country, being that one in the developing world. What we're talking here is of the world's largest, and international global companies with global supply chains, which I think that it helps contextualize. So thank you for that, where we're discussing. Tomo, very quickly before we move to the regulators, because the questions are piling up for the regulators, very quickly, what about reporting progress? What do you think about, should we make reporting progress mandatory? Should be annually? Do you agree that it should be verified? Tell us.
Sure. So first of all, progress, definitely. That's you can't just say, oh, you have great transition plans, so we'll finance you and we'll come back in 30 years. That's not happen, right? And as I said in the beginning, our transition plan basically we're relying on our client's transition plan. So of course, assessing transition plan is important, but you need to make sure that you track the progress. But the key here isn't just about, are you hitting the target, yes or no? Show me the KPI. If you miss it, your interest will go up or whatever. I don't think the story should be that simple. Rather, we need to listen. And that's where I spoke a little bit about the sensitivity, because, the emission reduction isn't something you can, pull one lever and all of a sudden can reduce in the next day or so, right? There are so many factors that may be outside of your control. For example, energy, where CO2 emission from energy. If you're not energy company, there's no way you can change that right away. But unless the energy itself will become green, there's no way you can reduce your scope 2, right? And our client's scope 2 is our scope 3. So there's that dependency. So of course we need to understand and monitor the progress. But if a client misses a KPI, we need to go and listen. We need to go and listen and understand, why did you miss? What are you going to do? And how can we collectively address, as opposed to say, we're going to withdraw your, the loan just because you missed the KPI. So progress is important, but how do you use it is different story, right? You don't want to just jump to a conclusion. So that's one thing about the progress. On credibility verification, that's a little bit difficult discussion to be had. So in terms of, for example, data accuracy, of course we want data to be accurate. But when it comes to strategy, I don't know who can, for example, verify that one company's strategy is good, right? And as we heard in the previous panel, I thought that was interesting. Who's good? Who are the verified verifier? Unless the verifier is good, the verification may be misleading, because if somebody just starts saying, oh, company A has great plan, B, C, they all have great plan, then all of a sudden we may jump to these verification and say, okay, they all have great plan, but the reality may be totally wrong, right? So we need to think about this data accuracy. It's for the accounting purposes and non-financial accounting. I'm sure the third party can verify the accuracy of the data, but when it comes to strategy, how possible is it? How likely is it? What are the dependency? What are the sensitivities? I'm not sure who can actually verify for all of us to say, okay, this plan is credible, right? So there's a bit of an open question around who can verify. And one thing we need to keep in our mind is this should not mislead all the stakeholder. If we all of a sudden say everyone verifies, and who knows what's going to happen 3 years from now. So we cannot just say anybody can verify. So we need to, if this has to be verified, we need to have a very good standard. And as Helena, you said, maybe this should only apply to largest corporate in the beginning, because I don't think there's sufficient number of third party who can do all these work for the thousands of company out there. So let me stop there.
Thank you, Tom. And thank you so much, because you gave me the opportunity to mention that we also, one of the calls that we had was precisely on the assessment framework. Yeah, let me explain. For auditors and verifiers, in order to conduct limited or reasonable assurance, they need a framework, right? It's called the assurance framework. And although the ISAE, which is the International Framework 3000, has been recently revised in terms of sustainability assurance, there's still a question mark whether or not it's fit for purpose, in the sense of for net zero pledges and for the details of transition plans that we're talking about. So one of our ask was, well, it might be worth to conduct an assessment to see whether or not it's fit for purpose. Yeah. So thank you for bringing that issue to the table. Let's now move to the regulators. Martin, you've been listening to the financial institutions and how important transition plans is for them, and that they are actually comparable and unifiable. But in fact, making transition plans mandatory in the EU is on the making, right, Martin? You're looking at transition plans, reporting on transition plans, and even providing some standards. So tell us about it. This morning, Paul Hang mentioned the CSRD and the Triple D. Sorry for the acronyms. I'll let you explain it, Martin. Over to you.
Thank you very much, Helena, and good afternoon to you all. Congratulations to Nick on organizing this very topical event. As you know, last year in our strategy, we identified transition and calibrating the right pace on the transition pathways as one of the key priorities. And now it's really becoming a reality, and we intend to step up our efforts on these topics. So this event is really very helpful and contributing to these efforts. Congratulations also to you, Helena, and obviously all members of the HLEC, because the report is also very useful in this context. Now, let me say maybe a few words why we think that transition is important before I go into the transition plans, because transition plans obviously are super important, but there are other elements of the transition story. This agenda of sustainable finance has never been for us a kind of an agenda that would endorse only those that are already in the sustainable space, that are already green today. It's certainly not an agenda that would be about shaming and blaming those who are facing the most significant challenges. This agenda is really about supporting those that actually have really the biggest challenge on their way towards net zero and meeting all these ambitious environmental targets. And we did recognize in our strategy that we need to do harder in explaining how the different pieces that we have put in place in the sustainable finance agenda, either through regulation or also through the enabling framework. We have also developed a number of tools, how they can work together in order to deliver the desired outcome. Since you asked specifically about the transition plans, this is for us one of the key tools that again would bridge the situation as it currently is with the future. And although everybody has to ultimately reach the targets that we all agreed, there are different pathways. And here we would like to talk not only about how you phase in the sustainable stuff, I mean, how you phase in green, but also how you phase out the stuff that is harming, that would not be compatible over the medium to long term with those targets, and how you manage resilience, how you mentioned, how you manage the different risks. So for us, this principle of double materiality is really important in the context of transition plans. Now, specifically to your question, where are we on the transition plans in the regulatory frameworks? We actually have three main references to the transition plans in the latest frameworks. The first one is obviously the disclosure, which is already agreed, the CSRD framework. There will be level 2 standards, and we are working now hard to make it clear what exactly is meant by the transition plans. The second piece is the behavioral change that we would like to support, and that's obviously the Corporate Sustainability Due Diligence Directive that is currently under negotiations, which will require corporates, big companies to have these transition plans. So we are not only talking about transparency, but an obligation to have those plans to trigger the behavioral change. And finally, we also, I mentioned resilience. We have reference to the transition plans in our prudential frameworks, especially for banks in the CRD, CRR. Now, this is the regulatory framework. We have not been overly prescriptive in those pieces of regulation, because we believe, like we have always believed, that this agenda should be a smart mixture of a regulatory framework and leaving some space and flexibility to the market. And I mentioned that everybody is starting from different positions. Everybody is facing different challenges, so we do need to kind of cater for these specificities. So we have not yet prescribed in a very detailed way, I mean, how a transition plan of a company should look like. We are obviously discussing the right balance, but we don't believe that, it would be a good idea to have a full-fledged manual of 60 pages that would require big companies to comply with. This transition plan is a very important tool, but in order to make an impact, it has to be a useful tool. And here I would like to make a bridge with the other tools that we have put in place with our framework, which is the EU taxonomy. Helena, you would certainly agree that your hobby horse recognizing capex under EU taxonomy and how actually taxonomy could be used in the context of the transition plans, is something that we definitely would like to discuss. The climate benchmarks, we have climate benchmark regulations. We have two types of benchmarks that can be very relevant for the transition plans. And of course, the European Green Bond Standard that are now in the negotiations in the final phase. And there are also very important elements for CAPEX and for recognition of transition. So for us, I mean, just to conclude, I mean, your first, to answer your first question, for us, it's a really a kind of magic of combining a smart regulation, providing for a clarity in terms of the framework. I mentioned the three pieces that have different objectives, but also we need to kind of leave the space, and we certainly do not intend to, you know, be overly prescriptive at this current juncture. Finally, my final point is that some international work has been mentioned earlier. For us, what is really important in the European Union is the double materiality principle. So we do believe that these transition plans should not cover only the risk side and how, again, companies are going to manage their risks stemming from climate change and environmental degradation, but also the impact of their operations on climate and environment. And here, I mean, we would like to see, you know, this double materiality principle to be reflected in those transition plans, certainly. Thank you.
Thank you, Martin. Two small comments from my side. The first one is that I fully agree with you with the double materiality, and in fact, the report of the UNH, like as I mentioned before, is very clear. This is about, you know, meeting the 1.5 target. It's about that the transition plans have to be consistent with the latest IPCC model pathways in line with the objective of 1.5 with no or little overshoot. So I think that that one point was very, very important for us, and we fully agree. The second one is that you would be very glad to know, and we had a little discussion before earlier on today, actually with Nathan Fabian, on the importance of CAPEX and the importance, you know, as part of, let's say, forgive me, it is CAPEX alignment with, in this case, the EU taxonomy, but any green taxonomy that is consistent with 1.5, how important indicated it is to prove, you know, that a company is walking the talk, and how the CAPEX plans is like a subset of that overall transition plan. So we've seen there the connection that you were mentioning between the taxonomy and the transition plan. So very pleased that you mentioned that. So before going back to you, Martin, and developing a little bit further this behavioral change that is so important, you know, that you were mentioning, I want to bring Kris into the conversation. We were talking about how important it is to have an international standard. You've been directly working on the setting of international minimum standards when it comes to sustainability-linked reporting requirements. Can you tell us a little bit more of what ISSB mandates in relation to transition plans? What exactly does it ask? And good afternoon, Kris.
Good afternoon, Helena, and thanks for having IOSCO on the panel today. If you take a step back and you look at the exposure draft that the ISSB has put forward, at the moment we have two exposure drafts. We have one that is called General Requirements, and that sets out essentially the philosophy and the architecture that will underpin all of the standards relating to sustainability going forward. And then you have a more specific one on climate to begin with. Within the exposure draft on climate, the ISSB has made it very clear, at least at the level we are at the moment, that if a company has a transition plan, then it should be made transparent to investors and to other potential stakeholders who may be interested in the reporting. And within that, the ISSB is very clear about setting out some of the aspects that should be part of such a transition plan. So to give a few examples, if you're using, given we had the voluntary carbon credit panel earlier, if you're using offset credits, you need to divulge those. If you have legacy assets that you will need to get rid of because they are energy intensive, for example, you'll need to explain how you're planning to do that and how that might impact your overall strategy. And equally, you have to highlight the risks and opportunities, because it's not just about risks, of your strategy with regards to both adaptation So how are you adapting to the new challenges ahead, but also mitigation? What are the activities that you're putting in place to mitigate the impact of your activities on climate change? So those are some of the aspects that the ISSB has put forward when it speaks of transition plans. It does encourage companies as well to provide metrics where they can, but as Tomo said, a transition plan is much more than quantitative information. It is about strategy at the end of the day. So it remains fairly high level at the moment with regards to those metrics and what those metrics might be.
Thank you, Kris. Let me ask you a follow-up question. Yeah, would you expect, when we look at, in fact, we look at how many jurisdictions in the world were either have or were developing climate or sustainability reporting link, yeah, and it was roughly around almost half of the world's GDP, yeah. If they are finally developing the US, the SEC, then we would increase at almost to 75%. Do you think that we could expect that 75% of the global economy to be bounded by at least ISSB climate disclosures?
I think certainly from IOSCO's perspective, we have been calling for this global baseline. We think it is important that at the very least, everybody starts from the same base, because it is otherwise impossible for companies like MUFG or Deutsche Bank, given that my fellow panelists, to actually be able to go into those companies, compare them depending on the jurisdiction they're in, and really understand both risks and opportunities associated with those companies. So certainly we are encouraging the use of the ISSB as a global baseline. I think we need to be realistic. However, it is normal that some jurisdictions want to go further than that and want to add to what that baseline might be. The European Union has been a pioneer in terms of sustainable finance more generally, and of course they're adopting a double materiality aspect and view on accounting of sustainability matters, whereas of course the ISSB has taken a single materiality lens to begin with. But I think certainly when we go through the endorsement process for the ISSB standards, we will be looking at whether they can act as an effective baseline that everybody can at the very least adopt, and if they need to build upon.
Thank you, Kris. One of the things that, I think that the report makes it very, very clear is that transparency is absolutely a must-have. It's fundamental, but at the same time, it's not enough. And we just hear it from Martin that the EU is the lead for the first time and is moving into, going beyond transparency and moving into behavioral change, which is really, really good news and very much aligned with the report. Martin, could you explain us a little bit the rationale behind the request on transition plans as part of the corporate sustainability due diligence directive, and how does the Commission envisions that that request will work in practice, and the extent to which maybe the recommendations of the UNSLA can help, can inform a little bit those level 2 standards. Thank you.
Thank you, Helena. No, I certainly agree that transparency of kind of being clear on what will have to happen in the transition plan is one thing, but then you can be very transparent that you are doing certain things, but maybe may not be sufficient. You may even not do it. You can be transparent. I am not doing it. So this is what we wanted to cater for in the as many other objectives under the due diligence directive, which we already prepared a proposal. This is now being negotiated. It is true that the EU is the leading jurisdiction in terms of legislation mandating big companies to put in place transition plans. So we have really good reasons why this obligation to do things, not only disclose, is so crucial. We have provided all the arguments in the impact assessment. I will not go into them in detail. Now, what we thought is really important to guide, not only guide, but to request the big companies in the scope, is to have a reference to the 1.5 degree. So that's absolute, and that's the limit. That's not necessarily the target. That's the limit. The emission reduction objectives. And we also have some provisions in our proposal on the link with directors' remuneration and reaching interim objectives and the plan itself. So here we have already introduced some elements, again, going beyond transparency. Now, it's very difficult for me at this current juncture today, I mean, to go further, because the proposal that the Commission put forward is now subject to negotiations, which are obviously, quite substantive. As you know, the member states have already agreed on an approach now. The discussions are speeding up also in the Parliament. And next year, I mean, it will be the decisive period for concluding those negotiations. Now, what I can say from my point of view, I mean, because it's really difficult to comment on the ongoing negotiations, is that we have always ensured consistency between the due diligence piece and the CSRD that already has been concluded. And we wanted to, first of all, avoid any burdens. So as long, you already do a lot of things under CSRD, then the obligation to do certain things, will not cause additional burdens for a company. So there is already a lot of synergy and consideration about the compatibility and coherence of these two pieces. But what I can say from the sustainable finance perspective, from the disclosure perspective, I mentioned that now the EFRAG task force has delivered their recommendations for specifying how the level 2 could be done under the CSRD. What we intend to do next year, apart from the specification of which elements should be part of the transition plans, we also would like to articulate better how the individual pieces in our sustainable finance framework actually work together, and to guide. The key word is guide market participants how to use the existing toolkit of the sustainable finance framework to finance the transition. So as I mentioned earlier, this is not only about regulation, this is not only about being super prescriptive. We would like to leave some margin and flexibility to the market, but anything we do next year on the CSRD, to complement the details, will have to be obviously very coherent and consistent with what the due diligence framework will do later on. So, it's obviously not ideal that these two pieces are not having the same timeline for negotiations, but that's the reality. But just would like to reassure all stakeholders in Europe that we will ensure consistency between these two.
Martin, you never stop surprising me, because it just hit the nail on the head, because we just received a question from Matthias Muller, who was asking precisely about consistency between the different regulatory frameworks. He mentions that transition plan are mentioned in various regulations. Obviously CSRD, CSDD, but also mentions solvency and EU green bond standards, etc. And he asked how high is the risk of inconsistency between the multiple requirements. You have answered in a way, but I wanted to give you the opportunity if you wanted to add anything.
No, just to reassure stakeholders that we are actually looking at the consistency and coherence of everything we have done or we are doing on sustainable finance now as a matter of priority. We have gathered a number of suggestions from the stakeholders and also concerns. By the way, some of them are even legitimate. That really required some follow-up. So we are taking this very seriously, and so far we have not really detected any major risks of again creating additional burdens, because the fact that transition plans are referred in the CRD for the reasons that I mentioned, which are different reasons than the CSDDD have or the CSRD framework has. Maybe last point, Helena, your question was specifically on the CSDDD, and I was not particularly helpful to answer your question fully. What I can say is that the idea and the rationale of having this requirement in the CSDDD is not only to put a transition plan in place, but ultimately to also make sure that it's robust and reliable and ultimately it delivers the desired impact. So there is also the need to follow up and to make sure that the transition plan is a lively tool, a lively document that would ultimately facilitate the dialogue between companies, the financial sector, and any other stakeholders who have some stakes in the transition process.
Yeah. Thank you, Martin. And that refers back to what Tomo was saying, right? The importance as well afterwards to be able to assess transition plans from the different companies. Kris, We just heard, you just heard Martin, the European Union is moving towards behavioral regulation in this domain. How important do you believe that that move towards behavioral regulation is, Kris? And can you see that? Can we expect that in other jurisdictions? Thank you.
And the $1 million question, Helena, of whether we can expect that in other jurisdictions. Look, I'll caveat what I'm going to say by saying that IOSCO so far hasn't yet undertaken any work relating to transition plans. It is something we may consider going into 2023, but it hasn't either been discussed or agreed yet, as the work plan hasn't been discussed. But I think it makes a lot of sense when you start thinking about what a transition plan must look like and the goals behind a transition plan, in the same way as you look at the goals behind sustainability reporting, that you start moving through to behavioral regulation, you start putting in place requirements that are very specific. I take the point, I don't remember if it was by Viktoriya or by Tomo, that this needs to be a sort of carrot approach and about incentives for companies to disclose. The problem is, as we found many times with regulation coming into play, is that unless you put regulation into play, you end up with very inconsistent documents or reporting or behaviors coming out of companies, coming out of financial institutions, etc. Given the importance of transition plan, I think the move towards, you know, that so-called behavioral regulation and providing more detail, in many ways, in the same vein as some of the examples you've put in the report, Helena, sounds sensible to me. And I think that will help with not only being able to compare what companies are doing, but as Tomo was saying earlier, being able to have conversations with companies about, okay, you haven't met what you said you were going to meet. Why is that? Looking at the metrics, looking at the broader information around the strategy, linking that to the broader strategy to the company as well, because the transition plan isn't, you know, a document that is an island. It forms part of a broader strategy thinking for a company. So I think moving towards regulation should help with that, particularly if we can achieve it globally.
Thank you, Kris. We were just talking a minute ago about the importance of consistency, but consistency in the regulatory framework needs to go beyond consistency within the sustainable finance package, so to say. And I think it's fair to say that while non-state actors, you know, ought to raise the bar in terms of the quality of their pledges and plans, it is also fair to ask for a consistent and encouraging regulatory framework. You were mentioning it before, Martin, you know, it's almost like the carrot and the stick, right? To say it in a very simple language. But the reality is that partially because, as mentioned at the very beginning, the normative frameworks across the world are under construction. Consistency is not amongst the different areas, it's not always present. Let me give you an example. So one of the issues that is becoming more and more important is it's the need for investments in new technologies and products, right? They are key, particularly in certain sectors where there is no technological solution to reach net zero or not economically viable. However, these are often very, very costly, they're complex, and they're currently, many of them, in early stages of development. So in most cases, this can be done, you know, like join together different companies from within the same sector. They can join forces. And in most cases, this can be done under existing competition law with appropriate safeguards. But it's not always the case. And in fact, competition law, you know, I mean, let's be honest, it should ensure that it doesn't stand, you know, in the way. And it's a very interesting case that I identify in Austria. They just recently amended their competition law so that agreements that are now, I'm reading, make an essential contribution to an ecological, sustainable and climate neutral economy can be excluded from the general ban on anti-competitive agreements, as always, you know, if certain conditions are met. Another quick example would be on procurement policies. Yeah, procurement policies in some jurisdictions are already requiring suppliers bidding for major government contracts to publish plans outlining their greenhouse gas emissions and their commitment to achieve net zero by 2050, the latest. So we have one example of where, a current law might be a hurdle for advancing net zero, and examples on how you can actually encourage, right, that carrot that we were talking about. And this is because we realize about these two, let's say, this potential, these two double issues, if you allow me to say. That's why we thought about this second work stream that this new task on net zero regulation should focus on. So the second work stream should focus on different projects across jurisdiction or by jurisdiction to identify the regulatory hurdles on one hand, but also the opportunities on the other. With that long introduction, Martin, we in the platform and together with the Commission, we have worked on, we realized early on how in order to apply the taxonomy, because you had to say the taxonomy touches upon so many activities and you bring a certain criteria into the game, so to say, then it touches one regulation, the existing regulation. In the case, for example, a case in point was in buildings, the EPCs, right? And how that, in order to implement that taxonomy, there was a need to amend, the Energy Efficiency Directive and the Energy Building Directive in order to make EPCs consistent across Europe and information accessible to financial institutions. So, Martin, tell us how useful you think that it would be to create that sort of space where regulators from different domains exchange on net zero regulations and to achieve greater consistency. And you can talk about the EU if you want on one side, but also I would love you to give an opinion, more like globally. Thank you.
Well, Helena, I think that this would maybe deserve a separate workshop. Since I have 3 minutes, I will first explain, what we have tried to do in the Commission, because I think that the sustainable finance work stream is an excellent example where we have really connected the dots. At least we are trying. Okay, we are not yet there fully, but at least we have really invested a lot of efforts to connect the dots between what we are doing with our sustainable finance framework and the different sectoral legislations and sectoral pathways that are being developed elsewhere. I have to say that this agenda basically started properly back in 2017-18, but we didn't have a European Green Deal at the time. And actually, I felt that it was really a huge challenge. But I also have to say that the European Green Deal, when it came, helped enormously, because then the European Green Deal brought an agenda, clarity on the targets, clarity, hopefully now also much better now also on the pathways, which we are now connecting with our own work on taxonomy. And yes, Helena, you're absolutely right that when we developed the technical screening criteria in some sectors, when we were referring to some legislations, those legislations were not yet necessarily reaching the degree of ambition that was needed to correspond to the 1.5. That was also the reason why we had to go a bit further in some cases, right? That was also the key recommendation of the tech and the platform. But we did it again only in those cases where we really need it, because again we were obviously aware that we cannot invent the wheel twice for the same purpose. Now, what we have done in the Commission is that we are really linking the sustainable finance framework with the sectoral policies, and there is actually already a hub of colleagues working on those issues on a daily basis. You mentioned the platform. I think that the case of establishing the platform where we have put together the financial sector together with the companies was an excellent laboratory, if I may, to show where the gaps are, where the difficulties, where the challenges are. We even have set up a dedicated group with member states, where we didn't have only member states representatives from the finance ministries, but also ministries of environment. So we have also broken the silos there. And at the international level, Helena, there we obviously observed that many different parties are coming from different backgrounds, and they are basically confirming that what we are doing in Europe actually needs to happen elsewhere as well. So, we do need to cater for marrying, I always say, marry finance and environment and the different sectoral policies that we have. So I think that we are making good progress. Are we there? I don't think so. I think that like for everything, and the topic of this conference is transition, I think that we also need to have a good plan how we progress. I can only say that in the next platform, the next group of experts that we are now going to establish in the Commission will be even a much better mixture of experts coming from the financial sector, from the businesses, from other stakeholders, where all these different perspectives can be matched better together, and also to have a more forward-looking perspective on things, what still needs to be changed. And as you know, the new platform will not only focus on taxonomy, but on the whole framework. So we also acknowledge that we really need to go beyond the taxonomy angle. We need to have all perspectives for this agenda to work.
Thank you, Martin. Let me turn to Kris to have her views, whether or not that would be beneficial at international level and for other geographies. Not all jurisdictions have a Green Deal, right? That is sort of, encompasses all the climate-related policies, I should say, that has a very clear objective, which is to limit global temperatures to 1.5 to reach carbon neutrality for Europe at 2050. And also, Kris, could you tell us whether or not or what benefits it could bring to an organization such as IOSCO to have to be part of this sort of community of regulators, where regulators from different domains and areas, exchange views and experiences? Thank you.
Yes, of course. I'll start with the national level, and then I'll move on to the purely international. And I think that's where the IOSCO question comes in. Within national level, sorry, let me use an example. We have just released our proposed recommendations for the establishment of compliance carbon markets, and we have also released a discussion paper on the establishment of voluntary carbon markets and the oversight of those. When we were doing the work on compliance markets very specifically, one of the aspects we quickly realized was that IOSCO and financial regulators could have an impact on the behavior of market participants, the trading on a day-to-day basis, but there were many aspects within the functioning of those markets that actually currently fell into the remit of environmental regulators, for example. So very specific example, auctions for compliance. Carbon markets are not typically handled by financial regulators. That led us to propose a recommendation that at national level, as far as carbon markets are concerned, there should be better coordination from the regulatory community in those jurisdictions, bringing in environmental regulators, financial regulators, other government authorities that may be involved to discuss these items and really ensure that they work smoothly and that you do get all of those impacts taken into account. So definitely, if you take the carbon example, and you bring it up a level, I think it makes a lot of sense to try and do what the European Union is currently trying to do and identify where different laws and sectors may be essentially clashing against one another when it comes to the goals of sustainability more generally, not just finance. Now, if we take that to the international level, it's a bit harder, of course, to do it at international level, because you first need to identify nationally what are the potential challenges and then see how that applies to the international space. But if it can be done, and I think a lot of work will need to go into it, but it's not unfeasible. If it can be done, it would be very helpful, particularly for an organization like ours, because once again, taking the example of carbon markets, if this work and this sort of forum existed, we could present that type of work and bring in that expertise to make sure that whatever standard we come up with regards to sustainable finance has got the input of experts in other sectors and can really be helpful across the board and really function both for markets but also for the broader society's objectives. So essentially, it would make a lot of sense if it can be done.
Thank you, Kris. I'm conscious that we have very few minutes left, but I want to bring Tomo very quickly. Do you think the creation, of this community of regulator and policymakers to discuss and share experiences, from different domains could be helpful for global banks?
So, short answer, I fully agree. I think that's a great idea. Although two comments. One, there are of course prudential regulators gathering, like whether it's the FSB, Basel Committee. They're more focused on risk management, right? And here we're talking about transition plan for banks and transition plan for corporates. So who's going to review banks' transition plan? At the moment, I think this is still open question. So I'm sure, once we start developing transition plan, that is something supervisor will look at it, whether through the lens of risk management only or also about the delivery of net zero. I think that's something prudential regulator, I'm sure, will also have an interest in. But in terms of a corporate transition plan, this is something there has to be a minimum standard, whether it's the ISSB. But I think, Helena, your report suggested involvement of, for example, GFANZ. We're very active in GFANZ transition plan, creating this framework. So you also might want to invite GFANZ and net zero alliances, et cetera, so that it's not just regulator, but also private initiatives are also part of this discussion. So that's one comment. The other comment is, while you mentioned and everyone on this panel, we've been discussing about this 1.5 degrees scenario. That's very important. That's a starting point. However, when it comes to real economy, corporates, especially in Asia, they will have challenges to achieve net zero 2050. Some partially because of country NDC maybe 2060, or partially because of their electricity decarbonization. It will take some time, and energy transition is critical, right? So it's not just about 2050 net zero. If not, this is totally unacceptable. But rather, what's the challenges, right? How can we help you to achieve more 2050? If not, what can catalyze you to become more ambitious? I think it's more about asking the question in engagement, as opposed to say, are you committing 2050? If not, we will not support. I don't think it has to be like yes or no answer, but rather asking the right question and having engagement. That ought to be the approach, and I hope the committee of regulator will support such an engagement. Let me stop there. Thank you.
Yes, thank you, Tomo. I said before when we talked about 1.5 specifically by 2050, with such a clear criteria that has to be embedded in the transition plans, we were thinking once again of the world's largest companies and financial institutions. We're very much aware. I just want to be very, very sure that we're not talking about all companies, not least small, medium enterprises in developing countries, where the pathways might slightly different, So just want to make that very, very clear. But we expect the largest companies that operate across the world to actually commit to the global target, as they are global. But very quickly, we have 3 minutes left. I think that between Martin and Kris, do you think you can have 1 minute each of just a few comments on how important it is to build capacity, to train also policymakers, regulators, and the key stakeholders, when it comes to implement policy, when it comes to develop regulation, given how new this whole area is, and particularly around sustainable finance. I don't know who wants to start. Martin, I'll start with you. One of the things I think that we really learned over the past few years in Europe is that for the very first time we are creating policy and regulation that requires, on one hand, high level of understanding and knowledge on financial regulation, but at the same time in so many other areas, right? And scientifics, you said it, the platform has from scientists, corporates, financial institutions, etc., because you need all that knowledge. So how can we scale that up, across the world?
Helena, there is never enough efforts on the training and capacity building. But what I can say is that in Europe, and by the way, in the European Commission, we have a department, even the whole Directorate General, that is supposed to, and is actually very heavily supporting member states in implementing big reforms. And since the agenda of sustainable finance and promoting successful story with financing transition is a very important reform. This Directorate General is actually investing a lot of resources to provide this training and capacity building to member states, experts and authorities, especially in the area of sustainable finance. A particular reason, and Nick will certainly know why I'm saying it, my former boss who started the agenda on sustainable finance, Mario Nava, is now the Director General, and he's very passionate about that. So we are doing quite a lot. I also need to mention, obviously, the InvestEU Hub, obviously all the trainings that the ESAs, the European supervisory agencies, are doing, the ECB, the EIB work, all the public institutions we have on the platform are doing already a great job. Is it enough? Not really, given the challenge we have. Thank you.
Thank you, Martin. Kris, very quickly, can you answer in 1 minute? Because IOSCO has already a program on capacity building. Tell us how important it is, you know.
Helena, I can only join Martin in saying it's of utmost important. You're right, we have a specific program on capacity building. It is started training on the ISSB standards to make sure that if IOSCO endorses, then jurisdictions can move very quickly into implementation of those standards, but it will go beyond that in the future. And I think our main aim has been to ensure that northern jurisdictions and southern jurisdictions can come together and really learn from one another, that the experienced jurisdictions can help the perhaps lesser experienced jurisdictions in terms of implementing and you know, thinking about the challenges for supervision with regards to sustainable finance. The last thing I would like to add, and I'm conscious of time, is we're doing it at the level of financial regulators, but this isn't sufficient, as we've been talking about, because there is so many interlinkages of knowledge and expertise. So some of the policy building also across sectors actually could be quite helpful, in addition to the work that IOSCO is doing or that the European Commission is doing within the European Union.
Thank you so much, Kris. And thank you so much, Tomo, Martin, Viktoriya as well. It's been a fascinating conversation, as usual. You know, it feels like we're short of time, but I'm sure, and I hope that we have another occasion to continue the debate. Thank you so much and have a lovely evening. I'm going to pass it over to Nick now. Thank you.
Helena, big thank you to you and to all the panelists, to Kris, Viktoriya, Martin and Tomo for a fascinating discussion. I'm not sure whether I should thank Tomo the most for staying up so late, but we've had so many people from so many different time zones dial in late, early. It shows the importance of the issue. But I thought this panel was absolutely excellent, as were all the others. But from a process perspective, public policy perspective, I found this particularly pertinent and interesting.